everyone, welcome back to another episode. Today we are here with Dotan Melech of CTrust, the CEO of the company. They're a credit risk rating agency, and I'll let Dotan introduce himself, and we'll kick this interview off.
Thank you, Raymond. I appreciate having me. My name is Dotan Melech. I'm the CEO of CTrust, the credit rating agency for the cannabis industry, specializing in both marijuana and hemp. That's coming up next year, scoring and monitoring for the benefit of the industry, hoping that our efforts will yield better liquidity and better access to traditional terms and traditional financing.
Excellent, excellent. And yeah, for us joining the industry or joining us for the first time, as we know, the cannabis industry the last few years, it's been a bit of a struggle. There's market saturation. There's still the 280E tax issue. There's outside sources that we're competing against. And so, yeah, if companies do end up going out of business, bankruptcy is not really an option for them. So they kind of either end up in receivership or trying to sort it out themselves. And so I know you have some experience with receiverships, Dotan. Can you tell me just a little bit about your time doing that? Because I feel like it feeds into what we're doing with CTrust. CTrust is trying to prevent companies from going sideways and going out of business, but inevitably it does happen. So can we just talk about what does happen if some of these cannabis companies go out of business, and how do we sort things out between the various assets of the business and the ownership group?
Yes, Raymond, I think it's a great question. And I think, for us, from a learning curve perspective, we kind of learn by elimination, right? Of what not to do rather than what to do, because most of my life I spent on the distress side of the equation. Just to back up a little bit, I actually started as a young engineer. I got my engineering degree and I wanted to specialize in building casinos, and I actually have done that for a while. But the one thing is very obvious. You can't take the engineer out of the person, regardless of what environment you put them in. Things evolved as I developed in my career, and I was exposed to the legal world, and was adopted, I would say, for lack of a better description, by Bank of America to be one of their choices asset management service company back in 2008, when things were pretty bad. That was my first exposure, in essence, to the receivership world, where a lot of companies and assets have gone into a distressed category due to the market conditions, and banks had the need to find independent person, if you will, independent company that can step in the capacity of a receiver and take over these assets and try to either fix them up and facilitate the foreclosure process, or them under the receivership control of the courts. Essentially, receivership is a court action. It's an office. A receiver is a person that is acting as an officer of the court in an existing lawsuit, whereas receivership is a remedy that the courts will utilize. It's considered to be a very extreme remedy, because at that point, controls is being lost by existing management and the people that are holding the keys, if you will, to the kingdom. And that receiver now has, for the most part, and it really depends on what the order says when the court appoints a receiver, has the responsibility of taking possession, controlling, preserving, marshaling, all the keywords that essentially results in a form of restructuring or liquidation of those assets. When a business gets into a receivership situation, it's kind of the last resort. For the most part, there's very low likelihood of a company coming back from receivership into a fully operational, similarly to what you see in the bankruptcy world. So after acting as a receiver for quite some time, I was invited to join the panel, the bankruptcy panel of Region 17, which is an appointment by the U.S. Trustee Office. It's a federal appointment of an independent, and I'm sure a lot of your audience CPAs have either been or involved or know trustees, because most trustees, I would say even 98% of all trustees in the country, and there's about 1,200, are either CPAs or attorneys. And I happen to be neither. Actually, you brought an engineer again. I blame the bankruptcy system for bringing an engineer into the space because I have the tendency to develop processes and ideas behind how to solve these problems, creating formulation and a very systematic way to approach a distress situation, which is the reason why I mentioned engineering early on, because it was just the mindset of how to approach it. So I've done between bankruptcy and receivership about 9,900 cases in multiple courts and states. And I've seen a lot of bad and ugly. And when companies get into this unfortunate predicament, in my mind, that is what constitutes a failure. Because at that point, not only you failed yourself in a position of managing the company, but also you failed your shareholders, your partners, and at that point, it becomes a business that needs to be managed, if you will, by the court system, not the most efficient way to fix a problem. And I can tell you that being there and doing it for that long with so many cases, it's really the demise, if you will, for the most part. Bankruptcy is not available to cannabis companies today. That may change, most likely will change. But at the moment, the only recourse, the only last resort option that is available to companies and creditors, for the most part, to try to preserve as much of the value that exists is by the appointment of a receiver if they can't work anything out outside of the court system. Once you get into that, it's really is a lose-lose situation by definition.
Yeah.
So
That is interesting. And having seen 9,000 cases of anything, it's like that's a lot. So you can respect the experience there. And I guess just before we segue into CTrust and kind of the problem it's had to solve, just I'm an auditor by trade, so I kind of find this stuff very interesting as well. Forensic audit, F&O audit. So looking through just at a high level, obviously, 2008, the market took a very, a turn for the worse. So outside of market conditions causing companies to fail, just at a high level, out of the 9,000 cases, do you have some things that are like common things that happen that cause companies that either have a good product and a good team to fail? And I kind of just thought of that question today of like, is it the product or service wasn't ready for the market, or was the ownership just couldn't come on a clear vision and keep executing on that vision? What would you say are just some reasons these companies fail? Because to your point, they have a lot of assets when they go south. So like, how did a company with this much resources not figure it out?
it's a great question, Raymond. And market condition is a major factor. No question. The environment is, and we'll talk about it, shortly when we dive into CTrust. But market condition matters. But for the most part, what I've seen that was common is human nature. A lot of the receivership and bankruptcy are a result of emotions, anger, feeling like you've been stiffed or lied to or cheated or defrauded, or misrepresentation type of issues. So it's really a lot of disputes. So when the market conditions improves, you see more and more partnership disputes and fights around promises that were not kept. But in a bad market condition, you just see more of it, and some of it is just violating loan covenants because you simply cannot support the debt that you took on. And that happens too. But really, the one thing that I've seen that happen more often than not is human nature, is the emotions behind essentially going after and using the legal system to pursue some anger and some breach of agreements and violations and fraud. So a lot of that. I've seen a lot of partnership disputes and creditors essentially losing trust, completely losing trust in the current management, and the only way in their mind that they can regain visibility into what is happening in the company that betrayed them is to involve the court system. And I've seen more cases, especially in the cannabis industry, that are around that type of a situation where management made decisions, they lost their faith and trust of their creditors, and their creditors want to protect their rights, so they're utilizing the legal system to do so.
No, I wish it was some like, I wish it wasn't human nature and it was something more like, all right, I can see this, I can avoid this. And we see it a lot too in the cannabis industry because there's always these ownership groups that need to come together of usually capital, usually a key person of interest locally, because every market you got to win the license locally. And then there's a cannabis industry specific person. And those three people, they just struggle to get along. But the winning cannabis companies, they do get along and they are able to set their egos aside and work together for the greater good of the company and the product and the mission that they're, the problem they're solving. They know they have a lot of employees relying on them to work together as management and keep the creditors happy. But if those, operators and creditors or lenders can't communicate well, as you've seen, that's usually what does it in. On that note, I think that's a good segue into CTrust. Since now that we understand receivership and what happens when companies go sideways, let's try to talk about CTrust and just tell me a little bit about, because some people might not have heard of you guys. And so just specifically, who are the owners of CTrust? How are you created? And what is the key problem that you're excited to solve?
Um, very excited to solve. This is a big problem, and I think that's what intrigued me. As again, back to the engineering mindset, the size of the problem was what the impact that we can have. The passion behind making so much impact was a main reason for me to kind of take it on. And about 3 years ago, I met with Bob Hoban, my partner, and we started CTrust in literally in the basement of an old building in downtown Denver, where Clark Hill offices were housed at the time. They moved since, and we've just sat in a room. The door was actually a shelf of a bookshelf that you can even, and it was just the design of these old buildings, and on the whiteboard we mapped out the problem and we looked at the issues. And I brought my experience from the distress, receivership, bankruptcy, workout, asset management type of perspective. And Bob obviously had the legal and regulatory and framework perspective, given his extensive experience in the industry for almost 2 decades. Globally as well. One of the first law firms it was created by Bob Hoban that was exclusively for the cannabis space. So we put our minds together and we figure out that this is a big problem that really needs a certain level of expertise and the perspective that we bring, plus additional expertise that we needed to supplement our understanding and our knowledge of what is happening in the space. And we enhanced the team with additional partners. And you mentioned a few: Chip Schweiger, Ted Robinson, Scott Rutledge, Mitch Harhay. Every individual in our team has been in the space and out of the space and coming into the space in different positions. So we have operators that Ted Robinson was running a company, an MSO, and he came from the mortgage world. So you have this unique perspective. You have Mitch Harhay, technology experts that have done amazing things in his career, became a technology consultant and expert to the cannabis industry. And Chip Schweiger started one of the first, I think he was a DOPE CFO client when he first started, to start an accounting firm for the cannabis. So that the perspective of the team, the brain trust, really helped shape up the solution that CTrust offers the market today. And we know that there's going to be more knowledge and expertise that we're going to need over time. And working with companies and organizations like yours means a lot. We want to hear from everybody. We want to learn from everybody. But what we have today, I feel, is, as a team, is very strong, and the perspective is what created the solution we have today.
Awesome, awesome. And yeah, looking at the founders and the ownership team of there, it's one of the stronger ones in the cannabis industry, just from the perspective of both credit rating and risk rating agencies, but then also cannabis knowledge. And then the nuances of what you guys do, it affects so many other aspects of business where you do need to bring in finance professionals, legal. So on that note, I guess just a question that came to my mind right away is, why hasn't a CTrust been created yet in the cannabis industry to solve this problem? Why were you guys one of the first ones, or at least the ones to do it in such an efficient and kind of more of a clean way? So what was the holdup from cannabis companies getting these business credit scores in the past?
That's a great question. I would like to know as well why, but I think it needed to have this type of thinking, the ability to formulate something that is pretty fragmented and scattered. The lack of transparency, the lack of standardization, the lack of trust that we've noticing in the industry, even peer to peer, not necessarily dealing with service providers and financial institutions. Uh, the equity, having access to all those problems, as well as having this mindset that you can formulate and build something that addresses all these issues and the problems that we've noticed. It wasn't just one problem. I mean, high cost of capital, that's a big problem too. So we saw all these, we made a list of all the issues that the industry is facing based on our own experience, hands on, not what we were told, but what we've seen firsthand. And I think it needed to have a team, and maybe you needed an engineer. I don't know, but you needed to think about it and approach it from a very systematic, formulaic process, if you will. How do I take all this data, all this information that we have? Because think about CTrust is essentially a reverse engineering of
Yeah.
failure. And we defined failure earlier of what it means. If you end up in receivership, that's a failure. If you end up in bankruptcy, that's a failure. That's insolvency. Now, if you reverse engineer it and you know all the factors in any industry, regardless of whether cannabis or not, that make up or what bring a company to that unfortunate predicament, you can reverse engineer it and have those signals and those signs already identified early on, because it's no different when you look at a company or you look at a patient from in the medical world. It's no different. Symptoms are
Yeah.
symptoms. And if you can't identify symptoms, you're certainly going to be too late in trying to solve the problem, because it sometimes gets out of control. And in business, when it gets out of control, it spirals down and immediately finds its way in the legal system. Not again, I keep telling people, avoid, I come from the war, avoid the battle. There's ways that you can do things and you can watch and manage your risk. Essentially, it's all coming from that risk
Yeah.
perspective.
Hmm.
Now, do it now, because nobody wants to end up there. This is no one in the beautiful presentations. I can tell you, I've seen a beautiful decks being prepared by serious companies. Nobody put as the last phase of their business plan, I'm going to file bankruptcy or I'm going to go into receivership. That is not a desired outcome, period. So why not put the effort up front? Be proactive about it. Identify those symptoms that we already know after they occur, too late, what they look like. Avoid those issues and then grow and thrive, which is really what we're here to do. We're here to advocate for those that are willing to put up the time and the effort and the work to be sustainable, to grow, to exceed, to succeed, and advocate on their behalf so they can have access to affordable capital. I mean, right now, the cost of capital in the cannabis industry is not sustainable.
Yeah, it's very prohibitive. And that's kind of what we say. It's like with if you have a correct finance function, getting to terms is not the hard part. It's getting debt that's, you can actually manage it. That's like not so expensive or not so high in cost that you can't support it. And so that's kind of why we love credit scores. Like, okay, this kind of starts to normalize us trying to go and get loans and everything. And the two big things that kind of I took away from what you were explaining is the biggest problems you solve. And again, that's why even from the finance side of these cannabis companies is access to capital and AR aging and just the credit granting to our actual customers. And I know right now we're solving the main problem of getting access to capital at a reasonable cost, but as it becomes more normal that all cannabis companies have credit scores and it's very common, we can use that in operations when we're starting to grant credit to our customers. Because as you know, AR aging and defaults are becoming far more common in the cannabis industry. California's had some pretty famous ones here in 2024 of companies that gone out of business. And if they owed companies money, they're pretty much not going to see anything. And so having all of these companies start to operate from having credit scores, knowing what their credit score is, and then more importantly, like you said, Dotan, how do we improve this credit score to your point so we can reverse engineer failure? As a CFO, we always think of enterprise risk management, and that's the world that we live in is like, okay, well, what are the KPIs and benchmarks that I can look at for this business? So regardless of what they're doing, I know if it's about to go out of business. Like, what are the fundamentals of this business where I can see if it's a healthy business that's growing and good or it's a dying business? And a lot of it comes from our time on Wall Street where it's like we all had stock prices. And so it's like, okay, how do I make sure that we have everything in place that the stock price keeps going up and everybody's happy with it? Because to your point, there is things you can look at having seen companies go out of business. We're like, all right, that's an early indicator of cash flow issues. And as we know, that's kind of the oxygen of a business. And then there's other things too. So on that point, once you and I do like that you guys had to bring in so many different people to analyze the cannabis industry from the very, very high level and then solve the problems almost from the top down, because I think it takes a national solution because very quickly it will be a national market. Right now, every state is its individual cannabis market, but pretty much it's becoming a national market. So on that point, what are what's like the starting process for some of these companies that are working with CTrust to establish their credit score? And then once they have a baseline credit score, do they work with you guys to improve it? Could they also work with you guys to use this credit score to do something? Can you tell me a little bit about that process of how do they get their credit score? Then what do these CRBs do with their credit score?
Um, Very good question, but I want to back up because I want to piggyback on one of the things you said that you, as an auditor, as a CPA, can look at financials and understand through KPIs certain things that indicate financial health, and so on and so forth. CTrust goes beyond that. It is an important factor. Don't get me wrong. We look at what's called asset structure and character. Three areas. We have about up to, depending on the license type, 42 business categories that we evaluate and measure against. And we actually utilize over 1,700 correlation points to analyze the relationship between the variables that we analyze. So the technology is very robust, but it doesn't only look at the ability to pay, which is really primarily the CPA financial focus. It also looks at the discipline and the willingness. And that's kind of a parallel to the structure and the character. Those things do speak to some symptoms that are not necessarily can be seen right away on their financials. The financials are essentially a way to kind of cheer the efforts, right, all the way to that point. But what makes up the financial is the company's behavior, the underlying company operation, the culture, the structure, and how decisions are made, and how not only cash flows but also information flows. So we look at it about beyond that one aspect, even though it's one of the three areas that we analyze. Companies can obtain their scores for free. We offer CRBs. We refer to cannabis-related businesses as CRBs. I'm sure most companies are using that terminology, so it's becoming a known acronyms. We're very versed in throwing acronyms out there, so I just want to say something that people don't understand. So CRBs can get their score for free by going through what we consider the CTSIQ process. And that is the process to accumulate information, because we get it from three places. We get it from the CRB direct. They have a questionnaire. They have some information to upload. There's some interaction with the company because it's their score. It's their data. But we also get data directly through marketplaces and third parties. So we don't just look at the information provided from the CRB. We triangulate and compare to information that we obtain directly through data aggregators and data systems, and through a marketplace. We have a partnership with GreenCheck Verified. They aggregate information under the BSA and KYC and KYCC policies for the benefit of banks. So there's overlap there in terms of information that we can insert into our algorithm. Ultimately, a score is created. It's between 200 and 800. We made it intuitive because people can relate. You understand your score because this is how you measured personally. So you will, and there are 5 different buckets. There's very poor, poor, fair, good, and very good. Each bucket has a range of scores, so you know which bucket you fit in. And you are able to not only get a score and a confidence, which I will expand on in a second, you also get the data insight that make up your score. So you will actually see the categories that help your score go up. You'll see the category that are essentially neutral, and you'll see the categories that bring your score down. If nothing else, it's a management tool where you can improve your risk management operation within the company. I know a lot of companies are struggling with understanding how to manage risk, because risk is not subjective. It is something that fits within an environment that is bigger than the company itself. So it's hard to manage risk if you don't have the information that you need to understand where are you relative to everything else going on around you. So we provide the data insight. As far as improving your score, that is absolutely something that we would like companies to do, but we are Switzerland. We do not want to teach people how to score better if we created a machine and the algorithm that does it. In a way, we feel this is somewhat of a conflict. We want to work with companies like you and professionals throughout the industry to help companies improve their score and provide both sides with the information they need to see how they're doing. So we would like to maintain objectivity and build relationships with companies that can help improve the risk profile of their customers. It's in everybody's best interest.
Oh yeah.
As it relates to the score, we're not only generating a score through a machine that was designed around all this knowledge that we put together and the perspective that we all bring. We also measure our own score and create confidence by using subject matter experts. So every company that we score, we anonymize their data and we send it out to qualified, pre-qualified subject matter experts that work with us. And they essentially fill out a survey based on a set of data that we provide without knowing who it is for. And we utilize that survey to benchmark and see the distance between the results of the survey to the score the machine generated. That constitutes the confidence. The further it is from the machine generated, the lower the confidence. The closer it is, the higher the confidence. So it's a technology and a mathematical tool that we utilize. So there's a human touch. It's not just, hey, this is what the machine said. It also comes with a confidence tier that is based on an actual process with subject matter experts in various fields. So when we send out the survey, you'll have an operator. If it's a cultivation company, you'll have a cultivator. And they don't know who they're doing it for. They have no access to even identify. There's a 16-digit ID number. They can't reverse that. And we send it out to CPAs. We send it out to lawyers that specialize in the field. So we get perspective. See, financial advisors, consultants that work in the industry. We get the perspective of the SMEs, which we find extremely valuable.
No, and it's because it is extremely valuable. And that confidence score is very interesting because it just, again, it validates that this isn't some subjective score that we're giving cannabis businesses. It's very objective, it's very repeatable, it's very consistent. And it has to be that way because in traditional businesses outside of cannabis where we have credit scores, like we rely on these credit scores to know what interest rates to give them to even do business with them. And so like, again, it's one of those situations where something very traditional and common outside of the cannabis industry, when we bring it into the cannabis industry, it's almost like we're trying to convince them of a new business best practice. And it's like, no, trust me, this is business best practices from the finance function. Like, because I've seen your guys' setup. It's very easy and intuitive to use. Once you input the data and you see what's helping your score, what's hurting your score, you can draw a line almost immediately to your balance sheet and P&L and the people in your organization, the flow of financial data and op data and the information in the organization. And then you get to work. So it's like, all right, cool. Once we know where we need to spend the time to work, then we can do that because, yeah, some people just don't really know where to start. And that's where, I think you guys have a very intuitive starting point for these people because you can improve these credit scores. And the cannabis industry is a young industry. And so a lot of these companies are in their first, second, 5 years, there's not a lot of 10-year-old cannabis companies even because if there is, they're impressive. It's like, holy cow, they've been around for 10 years. So like these companies, as they grow and their credit scores grow over time, all this stuff will become more useful and not just to the investors and the owners, but the actual managers of these assets and these businesses, because I can look 18 months into the future and know I'm going to need X amount of money to expand. And then I can, to your point, reverse engineer of like, all right, let's use a credit score with speaking with these people to make sure we have, what we need in the future. So very interesting. I like that.
I will add, you mentioned something there again. I want to expand on how to price debt, right? One of the challenges and one of the problems we've seen in the market is it's very hard to compare cannabis debt, which is in our mind a new asset class, to anything else. So if you want to price real estate loan or you want to do an SBA or USDA, there's some parallels, there's some comparison, but it's not the same. You don't have the same subsidies, you don't have the same secondary market, you don't have, for liquidity, you don't have government guarantees, you don't have any of those tools that are available in other industries. And there's many ways to figure out what rate to charge those industries because it's been around for so long,
Yeah.
to your point. So we actually took our score further beyond a score confidence and the data insight that make up the score. We developed a risk-based pricing engine that essentially take the score and allows financial institutions to price the debt based on the score, based on the buckets, the 5 buckets I mentioned earlier. So you would know what range of interest rates you should expect depending on which bucket you fit in. So it helps communicate the cost of debt between and hopefully standardize and like you said, make it consistent because we apply the same principles to any company, regardless where they're at. I will touch upon the state uniqueness and how that affects the score because I think it's important. But for the purpose of pricing debt, the tool allows the risk-based pricing engine allows banks to at least at this stage evaluate the opportunity, understand how to price, and also make a determination within the bank because it's customized to their needs, which bucket you want to play in. Because some, the fair bucket and the good bucket is more lucrative than the very good, because those that have the best credit should be entitled to a lower cost of capital. That's the logic. That's the idea. And we launched that tool for banks at PBC. That was the first introduction. As it relates to the states and how we approach it, every state is different. Every state, in our mind, had to, and we went through that extensive process, and I tell you, it's a no easy task because not only you have to do it initially, you also have to monitor it over time. And that's where the value really comes in, is the monitoring. The fact that you score well today, that doesn't mean in 6 months you're going to be in the same place. You could be better, but you could be worse. And the monitoring aspect is becoming the most valuable value proposition we have. As it relates to the state, we score them individually. Every state has its own score. We don't publish it because it's a component of the score that affects companies within a particular state. So if, let's say, a 650 in California will be the same as 650 in Oklahoma or in New Jersey, because the adjustment were already made as it relates to the environment that they operate. Clearly, Oklahoma and California are not favorable environment today, and I'm sure they're all working through improving them, and there's a lot of lobbyists there doing a great job. But they got challenges, and I think that the market, whoever deploy capitals or take any type of risk into these markets, would like to know how it impacts those decisions. It doesn't mean they're not going to do business. It just means that the people that will do well in those states must excel in so many other things that they do very well because the state is not helping them, score better, right? And that will change over time because we do think that states, and I want to commend New York for realizing that some regulations don't work. So you change them, you pivot. You don't build on top of it and make it worse. You pivot. And states are not that quick to make those adjustments. So we actually monitor and score states on a regular basis for the purpose of being able to score a company within the state. accurately. So I
Yeah,
think I
excellent.
I think I want to kind of emphasize that. Another thing as it relates to the score that is the fact that we score by license.
Yeah.
It's per license. So if you have multiple licenses within an organization, you will get a score for your company, but it will consist of multiple scores of each of your license types, because each license has different categories or areas of concerns that you need to look at in order to accurately reflect the risk of that particular license. You can't really bundle this whole thing and say, I want to score for 100 licenses in different states. That is a not a possible task. We have to, even though we looked at things from high level to create the solution, we took the time, and it took us 3 years. It's 3 years later, here we are, right? And we just launched a couple of months ago. We're looking actually from the bottom up to be able to score and accurately reflect the risk profile of a company. And that's from the data collection and the areas that we focus on.
No, it's very awesome. And I'm just like nerding out on it. Just, we're physically in about 15 different state markets and serving clients between that. And so we see them all. And so you start to think of them nationally. But to your point, I'm from the Midwest. And so a cultivation company in Michigan compared to a cultivation company in Illinois, where Illinois, it's a limited license state, Michigan, pretty
Right.
wide open, they're going to be drastically different. And so I just want to commend you guys for taking the tedious time and effort and expertise to go by state, by license type, because even among states, they'll have slightly nuanced license types. And so, yes, you could just categorize them as cultivation, product manufacturing, and retail, the big three, and maybe there's some small transportation and lounges, but like realistic, even within those big three, there's different tiers of cultivation, there's different tier of product manufacturing, and restrictions about the size of the license type by the state, which to your point will impact the financials, which impact their score. And so I like that you guys brought it full circle of like, you really have to get into the license type by the state until there's a standard federal licensing system, which just between me and you, I think is years out. Like even with rescheduling, it's still years out from like a very federal standardized cannabis industry in America. But just on that note, real quick, some of the final questions here, because I want to be mindful of your time, is how will rescheduling impact the credit scores? Just we know it's going to happen in the future. At some point, it's more of an issue of when, not if. But obviously, like from my perspective, our taxes paid to the government go way down, so my free cash flow goes up. So now I have cash to pay down debt, do other things. So in theory, the financial health of our clients should go up with rescheduling. Not until that actually happens, but how will that affect CTrust and how are you guys planning for that or descheduling as well?
I don't know if it has much impact, because I think
Yeah.
that states are really going to insist on keeping things controlled within the state to a certain extent. I think it's a program that the state would. I mean, they enjoy the cash flow. I mean, let's face it. It does go toward things that the state need, schools, infrastructure, and whatnot. So I think states are going to want to preserve that these programs, and they will probably mature more. I think from our perspective, 280E may go away, but it's not forgiven, which means that still there's some hurdles to get through the liability that have been accrued or accumulated on the balance sheets of these companies. Now you see there's a lot of chatter about how MSOs are approaching it and whether there's a way. But as we all know, being in the world of bankruptcy and receivership, dealing with IRS agents that show up to these creditors' meetings and learning and understanding how they operate, they don't legislate, they execute. And in order for things to be forgiven and the liability to go away, which affects your ratios, there need to be some legislation or change in regulations. And I don't think the IRS is going to take the position that, oh, you don't owe it anymore because it's grandfathered in of some sort. I don't think that's the case. So I think from a liability perspective that affects the numbers and the score, that will remain until resolved. And I would encourage companies not to make unilateral decision against IRS rules. It doesn't work well. It doesn't end up well for the most part. So I think it affects the score somewhat, the fact that it's not forgiven. But it may be compensated by the fact that now profitability goes up, cash flow goes up, and he may not have as much impact because other things will offset or compensate. I do believe that more regulations, and this is my personal opinion, more regulations will come because with any scheduling or federal actions, they're going to have to assign someone to look over this, and there'll be some regulations that we're not aware of. I don't know what they are and what they could be, but there'll be some regulations. I do believe it may have an impact on interstate commerce. I think that in order to move product or at least be in certain markets or certain stores, there may be some federal licensing or federal compliance requirement to be able to do that. The state can do whatever they need to do within their borders, but once you go out and once you start working with multiple states, you start getting into the federal law and oversight. So I think that's where you're going to see some impact in that area. But I think it helps. I think if nothing else, when you open up the marketplace, I think visibility into credit worthiness of companies becomes a higher need, if nothing else, especially even if you try to globalize and deal with exports, how do you get visibility into a company at the company level, at the operational level, rather, if not through what we have to offer here? I think if anything, the demand for the score and the data that we process and analyze and produce for the benefit of all stakeholders will be more valuable. We may even see, a hockey stick in terms of the demand for it. But again, I remain bullish like yourself about the industry and where it's headed. And I think that the solution that we have for the market today is here to stay.
Awesome. I would agree. We're just going to keep consolidating, becoming larger and larger companies in the cannabis industry. And as these companies get bigger, it's hard figuring out if you want to do business with somebody in your state. It's like, imagine when they're in 5 states and you got to learn about this business. It's going to be stuff like this is important. Let's bring this into land. So wrapping up, CTrust, what do you guys have planned for just the rest of 2024? And then what are you excited about, into the future?
I'm excited about a lot of things. I'm excited about banks coming to the space. There are nearly 900 of them servicing the space today. And they all, I can tell you, thinking about lending. They're all trying to figure out how to do it and do it in a way that is within the tolerance of the bank risk. They already demonstrated that they are interested in the space and they want to grow their deposits and their relationships. I think lending is natural. I'm excited about the partnership with Coda and GreenCheck to offer liquidity to the space by bringing institutional dollars. Right now, there's an opportunity to tap into nearly $500 million that will be available through a participation program where institutions are partnering with banks to take up to 50% of the loan principal in second position. It gives banks a faster way to come to market, a safer way, because now not only they got a credit score and visibility into the credit profile of their borrowing on an ongoing basis, they now have an institution that is an expert in the field that is willing to take this, if you will, a higher risk at a higher cost, but the industry benefits because it's blended rates. So the bank are going to take lower risk, lower cost, and they'll take a piece at a higher risk, higher cost. Ultimately, the winner is the borrower. I'm excited for the refinancing opportunities coming up. There's nearly $15 billion of debt that needs to be refinanced in the next few years. I'm excited about the upcoming debt market report that was going to be released by Whitney Economics. And Bo Whitney was releasing some initial figures. Don't quote me on this, but we'll see what the report says, that the debt market is between 83 to 105 billion in the next decade. I'm excited to see how we can help shape up the debt market and help expedite it. Lots of things to be excited about. I'm excited about the great work that companies are doing. I'm excited about rescheduling. I think it's going to help a lot of companies go from being unprofitable, like the latest report released by Whitney Economics was 27% of the companies are profitable, about 40% are breaking even, and the rest are losing money. Well, I think that the transition to from 280E to no 280E can push a lot of these companies that are breaking even into the profit side, and I think that will help them in many ways. So, like I said, lots to be excited about. I think there are a lot of people in the industry doing great work, and like after 10 years, to me, it feels that it's time. We're ready. The industry is ready. The data is there. The professionalism is there. The reporting standard, thanks to companies like yourself, helping and guiding and helping and teaching companies how to do better business and how to keep records and how to document everything correctly, which is the beginning of being able to be credit worthy. It
Yeah.
sounds simple, but organization is a big deal. We're seeing the market evolving, maturing into a point where it can actually gain access. The market as a whole can gain access to things that the market was deprived of in the last decade. I'm very excited to see what's coming. I'm happy to be on this side of the equation, helping companies avoid seeing me on the other side, even though I don't do it anymore.
Yeah.
But someone like me on the other side probably will be for me redemption. So I'm looking forward to see how we can help companies do better.
Hey, everybody likes the redemption story, and I can relate coming from the auditor's side, like the other side, and now being on kind of helping people prevent audit and like keep ready for it. And so, no, really appreciate what you're doing for the industry. We're also very bullish on it, and we kind of feel your sense where it's traditioning, it's becoming more traditional, maturing, more sophisticated, and all that leads to just bigger, more complex businesses, which is usually better for the employees, the investors, the owners. And so, no, we're really excited about the industry. And again, just want to say thanks for your time again, Dotan. I know you're a busy man. I'll see you down in Chicago for Benzinga and probably some of these other events this year. But yeah, thanks again for your time, and we'll be in touch. All right. Talk to you
Thanks for
later.
having me, Raymond. Looking forward to seeing you at Benzinga.